Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Namaskar, my name is Shishir.
Welcome to the latest episode of State of Economy. We have with us Aditi Nayar, Chief Economist with ICRA. Aditi, just a quick take on the interim budget. So many things have been said already. And you have also written an article for our newspaper also. What is your quick assessment since more fine prints are already in there?
Thank you so much. Always a pleasure to be here. See, on the interim budget, the two main things that we were looking for were the fiscal deficit figure for FY24 and 25. And within that, what was the amount of capital expenditure that was penciled in and whether it looked realistic or not. So on both of these counts, we have been pleasantly surprised that the government is targeting a lower fiscal deficit to GDP ratio than what we had projected for FY24 and 25. And that within this, capex is actually slightly larger than what we had expected, particularly for FY25. Now, how is the fiscal math getting balanced? A little bit, we are apprehensive that the non-tax revenue numbers may be a little optimistic. That only time will tell. While the nominal GDP growth is higher than what we had expected, the overall tax revenue numbers are actually in line with our projections. So that seems to be quite comfortable. On capex itself, for FY25, the amount penciled in is 11.1 trillion, whereas we had projected a number of 10.2 trillion. So there's quite a large gap over there. And here our apprehension is that once the elections take place and presuming that the full budget is presented on July 1, which is already into the monsoon season, typically we tend to see that capex is tardy during the monsoon months. So actually a real pickup in capex may be quite back-ended in FY25, which may result in this number turning out to be ambitious. So we're not sure that 11.1 trillion can actually be completed in FY25, given the fact that the full budget would possibly be presented only around July.
Okay. Aditi, one issue is about this private sector investment. We are not seeing the kind of growth which we were expecting after boost in the public expenditure by the government. What is your assessment on that?
So, on private investment, basically what we feel is that the capacity utilization is close to that 75% mark, after which typically the private sector becomes more emboldened to bring in capacity expansion. At this point in time, what we are seeing is that there are capacity expansion plans in a number of different sectors. Like we are seeing airlines announcing large plans to buy aircraft. Many hotel chains are adding capacity. These two are some of the higher end services sector that we have. Even in manufacturing, there are various auto sector entities that have announced expansion, steel, cement, some of the more traditional sectors, even some of the newer age sectors like electric vehicles and data centers. So there are a number of sectors where there are plans to add capacity, but it's just not the same kind of decibel that we would have seen in previous up cycles of the private investment cycle. So this time it's more moderate. It's more it's less noisy in terms of the private capex environment. And this actually may end up being a little more sustainable than what we may have seen in the past. Otherwise, ingredients seem to be in place for private sector capex to broaden. The urban consumption demand from the surveys that we have from the RBI does seem to be fairly robust, although I would conjecture that even urban demand is uneven and rural demand is certainly cautious in our view. We're at the top of the rate cycle. The rate cuts are visible, and the cut cycle is not expected to be so deep that people would delay their capex plans to take advantage of lower rates. So I am hopeful that private sector capex will continue to broaden, and that it will also sustain over the next few quarters. But I don't expect it to be the same kind of very loud or exuberant private capex cycle that we have seen at times in the past.
Okay. Aditi, what about the state capex?
See, on state government capex, we have seen high growth being budgeted for FY24. And certainly in the first half of the year, the growth was high on a modest base. For the second half of the year, based on the data which is available so far, we do think that the capex target is likely to be missed. We don't think that the entire amount of capex is likely to take place in line with what the states had budgeted for FY24. Nevertheless, the YOY growth for FY24 should still remain healthy, even though it's likely to undershoot what had been planned for the year.
Okay. Now coming to the three high-frequency economic indicators which were out on 31st and then on 1st, and now that's GST number and the PMIs, manufacturing as well as the services. Now we are seeing GST collection more than 1.74 lakh crore. The latest figure is more than 1.74 lakh crore. Do you think that there is a time for going for the reforms, especially in the terms of rate rationalization?
See, that is a tough question, and I think ultimately that will depend on what the GST Council decides to do. My sense is that states may want to wait and see another year or two of high revenue growth before they're willing to discuss rate rationalization.
Okay. And the two PMIs, manufacturing as well as the services, of course, it is a quick survey-based kind of thing. So what are the indications, especially in terms of services PMI, which we are seeing at 61.8? So what are the indications you are getting?
So certainly the services PMI has painted a very exuberant picture. And I was saying, as I was saying earlier, this is kind of matching up to at least some of the services sectors where I was talking about the capacity expansion also being underway, like the hotel sector or the aviation sector. I frequently travel and I can see that flights are full. The prices of hotel rooms seem to be only moving in one direction, which is up. So clearly there is a lot of demand for these high-end services, and that is something that does seem to be getting reflected in a sense in the service sector PMI as well.
Okay. Now coming to the another high-frequency economic indicator, of course, the data will be out only next week. That is the inflation number. What is your expectation considering the food inflation is still stubborn?
So we had last penciled in a number of 5.2% for the CPI inflation for January. So a good amount of downstep from the previous month's number. And for FY24 as a whole, we are looking at an average CPI inflation of 5.3%. Now, if the monsoon is well distributed, then we are hopeful that the CPI inflation will moderate to 4.6% in FY25. But here, of course, big if is whether the monsoon will be well distributed, which is important for staples. And as far as perishables are concerned, quite often we do end up seeing almost every year we end up seeing a perishable price spike. So hopefully that is something that will get avoided in the coming fiscal year.
And what about January number?
January, we are at 5.2%.
Okay. Now coming to the final question, that is when the government is saying that we may end up with close to 7% GDP growth in FY25, while IMF has projected 6.5%, and many of the other agencies have projected between 6.3 to 6.5%. What is your reading?
For FY24 or FY25?
FY25 I'm talking about.
Okay, so FY25 we have a slightly lower number than what you just mentioned. Our own projection as of now for FY25 is 6.2%, and there are a couple of reasons for that. One, when we look at the agri situation after an uneven monsoon and uneven post-monsoon rainfall, reservoir levels in some geographies being lower than the historical averages, and the Rabi sowing also took quite a lot of time to catch up to the previous year's levels. Overall, the sense we have is that the rural mood is going to remain cautious until there is much better signals coming through on the rainfall front, which will have implications for the sowing and the output for the next year. So possibly rural demand will remain cautious, and tangible signs of a good monsoon, etc., would only be available after August. So it's going to be several months into FY25 before we could really expect there to be a major upshift in demand from the rural side. And the agri output also, there would be the lingering impact, particularly if the Rabi harvest is not good. That's something that will come into Q1, and it could exert some downward pressure on the overall growth rate. Second, very specific factor, presuming that the full budget is presented after elections on July 1, then with monsoons coming in after that, it's quite possible that capex will be very back-ended in FY25. And that is something that could moderate the growth rates for H1 temporarily, and therefore have an impact on the overall average growth for FY25. And on the exports front, we are not expecting any major exuberance to come through anytime soon. So exports growth will also remain one of the Achilles heels as far as the overall growth momentum is concerned in FY25, particularly on the merchandise side. And these are some of the reasons why we're a little below consensus in terms of our forecast of a 6.2% GDP growth in FY25. What would be the upsides? One upside would be if there is greater clarity and certainty earlier on that we're going to have a good monsoon and agricultural outlook. Second, I am not certain if state capex will be slow through the election months, or is it going to maintain the kind of pace that we saw last year. So if state capex is not back-ended and is front-loaded, then perhaps we could end up with a higher GDP growth now.
Thank you, Aditi.
Thank you.